return? No, you didn't get the 11-fold gain, but it's gone up 11-fold with definable bear markets in between that we've defined. And right now we turned bullish on gold in February 2016, 2.5 months off the bear low, which was 1,050. Right now we're 3,400 area. Nothing since then in that 10-year period has altered our annual momentum trend analysis of gold. And that's what do we mean by that? It's when you measure gold monthly action, monthly bars, like a price chart, but we measure them versus a 3-year average or 36-month average. And we plot them as an oscillator, meaning, okay, this month's high, low, and close are how much above or how much below that changing average. And it ends up, you have an oscillator. It goes above the zero line, it goes below it in bear market, et cetera, et cetera. Nothing structural in terms of defining the trend on momentum is even threatened right now in terms of breakage, downside break.
Mm-hmm. Okay.
We see all the evidence here that this pause in gold, 4 months now, total boredom, is about to launch again. And it probably will launch next month, my best guess. Now, look what's uniquely happened, though, in the last 4 months. While gold has gone sideways and yawning, not going down, but just sideways.
Yep.
Silver's gone up explosive. We've gone from the upper 20s to the upper 30s in that 4-month period. And if you look at GDX, for example, it's risen sharply as well, while gold stood still. So it used to be the other way around for the last several years. Since that 2020 upshot we had in gold, the miners in silver, it peaked basically in mid 2020. Gold had a range-bound situation, 20% to high-low, but silver and the miners tended to retreat more.
Right.
But arduous. They get nice rallies, but it'd be a zigzag to the downside while gold went sideways. That is shifting. It's shifted in the last several months, especially since April, where the miners, if you plot them as a spread, meaning you divide the price of GDX into gold ounce, express it as a percentage, and plot that chart.
Yeah.
And you'll see that it's broken out over trend structures that are easily defined when you plot that spread. Downtrends, horizontal lines, etc. So, and the same with silver. So what it argues to us is that, okay, now we've entered the phase where those parts of the monetary metals complex will lead gold. This has happened before, and usually when it happens, it's quite dramatic. In fact, if you go back and look at that bull market in 2001 to 2011, in 2010, silver went vertical while gold continued up, but silver exploded geometrically.
Right.
And we're at that phase now. In fact, if you even just look at a price chart of silver, any of your watchers, just go look on your quote screen and get a silver futures continuation chart, meaning it rotates to the next active contract. Okay. Go back to the 2022 low. Remember that low? That's when we paused from 2020, 2021, and it was flush in gold. It took it from like $2,000 down to $1,620. Well, silver also went down then, made a low. Miners, same story. If you plot the action since 2022 low, which would have been like August, September, you could plot a parallel uptrend channel on price even. You've emerged through the top. Yeah, an upward bull market, but at a definable angle of recurring rallies and lows that just stay in the tube, and frustrate people because you get these sell-offs in the tube, but it's still rising. They forget to see that. We've blown through the top of that. We did that about a month ago, and after doing it, we've paused, but we're above the channel top and comfortably quiet. So we've had a breakout, even evident on price, much less momentum, which already broke out before that. So I think we're headed to, pardon me, my camera is moving. I think silver's has entered now that acceleration phase. Our expectation is this. It's not outlandish. The $50 highs we saw in 1980 and 2011 in silver. Think about how much time has passed. Well, the decay in the money, even since 2011, has been enormous. So even just to get back to 50 isn't getting back to 50 in real dollar terms. We probably have to go to $200 silver just to match the 1980 peak, at $50. Okay.
Right.
I think we're going to go to $60 to $70. There was below the $50 highs, what I call idiot highs, because they really don't mean too much, especially in real terms. And do that this year in this surge that we've now commenced.
This year?
This year, meaning in the next 5 months. There might be a pause there. I'm not sure. But I think at least we're going to blow out the 50 and not even pause till we're credibly beyond it. Now, is that the end? No.
I've been at this long enough to know when the market's asleep and when it's just quietly loading the spring.
And right now, gold is doing that classic yawn-inducing sideways drift that most people mistake for nothing happening. 4 months of boredom, 4 months of pundits shrugging, traders moving on to chase AI stocks, and newsletter writers wondering if the metals trade is over. And in my experience, that's when the big move usually sneaks up on everyone. You can measure this in 100 different ways, but one of my favorite tools is the annual momentum trend. I'm not talking about some magical oscillator that blinks green when it's time to buy. I'm talking about cold, hard structure, monthly gold bars plotted against a 36-month moving average, then turned into an oscillator so you see how far above or below that long-term average price we are. You know what that chart says right now? It says nothing structural has broken, not even close. That's why when people tell me, Michael, isn't gold rolling over? I laugh, because the long-term momentum doesn't even have a scratch on it. What we've had since February 2016, when we turned bullish at $1,050 an ounce, is one of the most stable upward momentum profiles in decades. We've gone from 1,050 to the 3,400 area in that time without ever seeing a momentum break that would change the trend call. That's not a market in trouble. That's a market pausing before its next act. And if you want to bet against that kind of structural strength, be my guest. Just don't be surprised when you're explaining to your spouse in 6 months why you missed the rally of the decade. But here's the twist this time. While gold's been snoozing, silver has been throwing a party. In just the last 4 months, silver's gone from the high 20s to the high 30s. That's not a polite move, that's explosive. And while that was happening, the mining shares, look at the GDX for example, have quietly broken out. For years since the 2020 peak, we've seen the opposite. Gold would hold its ground, but miners and silver would bleed lower in a zigzag of disappointment. Rally, fade, slow erosion. But this spring, that flipped. Since April, the miners and silver have been leading, and that's a major tell. I like to look at spreads to catch leadership changes. Divide the GDX by the price of an ounce of gold, plot it as a percentage, and you can spot trendline breaks that signal a shift in who's driving the bus. We've broken out there. Silver's doing the same thing against gold. When that happens, you're moving into the phase of a bull market where the beta plays in the complex, miners and silver, start outrunning the steady plotter that is gold. Historically, that's when things get wild. Think back to 2010 to 2011. Gold climbed nicely, but silver went vertical. It doubled in months. And the miners, especially the quality mid-tiers and juniors, went berserk. We're back in that kind of phase. You can see it in a simple chart. Take a continuation silver futures chart from the 2022 low, around August or September. Draw a parallel uptrend channel. Price stayed in that channel for 2 years, frustrating traders with shakeouts but always recovering. A month ago, silver broke out over the top of that channel. Not just a head fake, but a clean breach followed by quiet consolidation above the breakout. That's what strength looks like. Now, people will ask, okay, but where can this really go? Let's get real. The famous $50 highs in silver, January 1980 and April 2011, aren't magical numbers. In inflation-adjusted terms, those highs are laughably low today. If you wanted to match the 1980 high in real purchasing power, you'd need silver north of $200 an ounce. And that's why when I say $60 to $70 is in play for this leg, I'm not being reckless. I'm being conservative. That's just blowing through the so-called idiot highs and stopping before we even get into historically fair value territory. And if you think $60 silver can't happen this year, you weren't around for 2010 to 2011 when silver ran from $17 to $49 in less than a year, 11 months. We've entered the acceleration phase. My work says we'll take out $50 in this surge, maybe not even pause there, and land somewhere in that $60 to $70 range before we catch our breath. And I mean this year, within the next 5 months. After that, there may be a pause, maybe a consolidation. But the big picture? This is not the end game.
We're in a different situation. I think you know it. Eric Sprott knows it. A lot of people know it. This isn't just another gold, silver bull market. This isn't just 1980 and then it's over and you go down to hell for the next couple of years, or 2011 and you go down to 2015. There are things going on out there that are far more disastrous, pending and already commenced, that will impact monetary metals. We don't call them precious metals. Platinum's a precious metal. Gold is a monetary. So is silver. And that is that when that shit hits the fan, pardon me, you have to edit that out. The central banks will go more berserk than they have ever been, because not only will stock market go down, but all the data points they like to chatter about, how, job market's looking good, which it really isn't when you look at the inside data. But once the market starts down, if you go back and look at the 2000 top, 2002 low, 2007 top, 2009, all the data points that they like to chatter about really started to go south in an obvious way once the stock market topped and started down, and finally people started pulling their hair, and there were the CEO says to the don't hire any more employees this month, we're on pause, or lay them off, and all of a sudden the data points will shift. That's when the central banks will go ape, and they always do. They always do. If you go back and look at those two tops, you'll see they started cutting rates like crazy. It didn't help the stock. What helped? Two markets went up during that time: gold and T-bonds. Question now is T-bonds. You mentioned that.
Yeah, please.
Yeah. Well, the T-bonds, they're not responding to the Fed. They usually don't, because that's the long end of the debt market. We're talking 30-year T-bond futures, not the 90-day stuff. When the Fed cuts rates like they did, back late last year, a couple times, took it off the high, the recent high, shallow high, by the way, in terms of rates historically. T-bonds went down in price, up in yield, despite them cutting rates. And if you look at a T-bond futures chart or a yield chart, which is the opposite they're clustered. T-bond prices are just laying on the floor, anemic looking, despite even during that drop in April in the stock market. Didn't help the bond market. They tried to go up in price. There was a nice rally into early April, but then they collapsed. And they're just laying here a point or two off the floor of the last actually several years. So the long-term rates are choking and they're not letting loose. The noose is not getting looser. It's just as tight as it was 2 years ago, which means there's a lot of big corporations, especially commercial real estate, and plus the government is hurting because of this. So we don't just have a mortgage problem like we did in 2007 to 9. Now suddenly it's government debt, not family mortgage. We all know that there's credit card excesses, by the consumer. They're at their limits. They're past due. We also know there's a lot of late filing of taxes now, increased sharply. People just can't pay it, so they delay, or they try to set up a plan. Something's hurting already. But when it becomes bleeding obvious to the central banks, gold already knows this is going to happen. Mm-hmm. That's why it's not sitting and waiting for the bad data points for the Fed to cut. It's already on its way. It knows. And not just the U.S., but the Japanese have been doing it, and we know the EU will. So that's the dynamite. So we watch the stock market because it's going to have an impact on the central banks, but also money flow. If people get out of the stock market, they go somewhere, and they usually go to those two things. But if you're a portfolio manager and you're looking at gold and T-bonds ain't working. Only gold's been working. Gold's up, despite the pause, is up a lot more than the stock market this year, the last 3 years, the last 10 years even. You go back to 2015, gold's beating, store somewhere near Wall Street. I remember, walk by the front and there was that book in the middle of I bought it. I still have it. They have a price chart pattern that very few people talk, called the broadening top. And it is exactly what I was talking about, where when you make a top, sometimes it's confusing and it makes a new high, even after it's really started the topping process.
One of the most dangerous mindsets in investing is thinking, it can't happen. I've heard that phrase right before every major move I've ever witnessed. In 1979, people swore silver couldn't go to $50. In 2008, they swore gold couldn't double in 3 years. And now in 2025, I'm hearing the same thing about $60 or $70 silver. The irony is that the same people who say it can't happen are the first ones to pile in at the top once it does. I like to call that the coffee spill indicator. That's when the price move is so big, so fast, that CNBC anchors physically spill their coffee reading it off the teleprompter. If you see someone on live TV say, silver's up 20% in the past week, and their voice cracks, we're getting close to a mania phase. And here's the thing about manias. They don't start at fair value. They start when the latecomers panic. But here's the structural case for why this move can keep running well past what people think is reasonable. First, the leadership baton has already passed from gold to silver and the miners. That shift is historically one of the most bullish signals for the entire metals complex. Second, the macro backdrop is a cocktail of all the ingredients you need for a blow-off. Real yields are falling, central banks are still net buyers of gold, and retail investors are waking up to the inflation they were told didn't exist. I've been tracking ETF flows closely. In the last 2 months, silver ETFs have seen their largest net inflows since 2020, and that's with silver still under $40. Imagine what happens when we print $50. Every headline, every tweet, every YouTube video will be screaming, "Silver breaks 40-year high," and the herd will stampede. Here's a fun stat to keep in your back pocket for cocktail parties. The total value of all silver mined in the world each year, at current prices, is less than what the US government borrows every single day. That's not hyperbole, that's math. The US deficit is running over $2 trillion a year, which is about $5.5 billion a day. Global silver mine output is around 800 million ounces. At $37 an ounce, that's just under $30 billion a year. The Treasury could theoretically buy every ounce mined for less than a week's worth of deficit spending. Think about that scale mismatch for a minute, and this is where I have to remind viewers. Silver is not some speculative tech stock with infinite potential production. It's a finite resource with extraction bottlenecks. Even if silver hit $100 tomorrow, most producers couldn't meaningfully increase output for years because the majority of silver comes from non-primary mines. You can't just flip a switch and double byproduct output without wrecking the economics of the primary metal being mined. Now let's address the obvious pushback. Won't high prices kill industrial demand? Maybe at the margins, yes. But here's what the industrial users know and the average investor doesn't. Silver's role in applications like solar, electronics, and medical is often non-substitutable, and the actual cost share in the finished product is tiny. Even if silver prices double, the impact on the cost of a $25,000 EV or a $500 smartphone is negligible. Industrial users will grumble, they'll hedge, but they won't stop buying. On the monetary side, silver's cheapness relative to gold is still extreme. The gold to silver ratio, the number of silver ounces it takes to buy 1 ounce of gold, is around 90 as I'm speaking. In past bull runs, that ratio has collapsed to the 30s or even 20s. If gold simply stays where it is and silver reverts to a 30-to-1 ratio, you're looking at triple-digit silver. That's without gold making another move higher, which I think it will. This is where psychology gets fascinating. Right now, silver bugs are excited, gold investors are patient, and the broader public couldn't care less. But once that $50 line is broken, you get a feedback loop. Higher prices bring more media attention brings more buying drives higher prices, and so on. It's the same cycle we saw in Bitcoin in 2017 and 2021. Nobody wanted it at $3,000, but everyone wanted it at $60,000. I remember 2011 vividly. Silver broke $40 and people who had never mentioned metals in their lives were asking me how to buy coins. By the time it kissed 49, I had friends trying to remortgage their homes to buy in. That's the mania phase. And here's the thing, manias always overshoot. Now, for those of you who've been stacking since $15 an ounce and are wondering whether to take profits, let me give you my perspective. I'm not your financial advisor, but I can tell you that selling your core position in the first acceleration phase of a secular bull market is like getting off a roller coaster after the first drop. The real adrenaline rush is still ahead. Yes, you can trade around the edges. Yes, you can hedge. But if this cycle mirrors past ones, the terminal phase will make today's prices look quaint. One of the reasons I'm so confident is the macro squeeze coming in currency markets. The dollar's trade-weighted index has been bleeding for months. The Fed's higher for longer narrative is running headfirst into an economy that's slowing under the weight of debt. At some point, they'll be forced to pivot, not because they want to, but because the bond market will make them. And when they do, real yields will crater, the dollar will weaken, and monetary metals will surge. We also can't ignore the geopolitical layer. Central banks, especially in the BRICS bloc, are actively de-dollarizing their reserves. They've been huge net buyers of gold for years, and while they're not yet significant buyers of silver, the moment silver's monetary profile reawakens, you could see sovereign demand emerge there too. Imagine India or China deciding to stockpile silver for strategic industrial needs. Prices would gap higher overnight. And let's sprinkle in a little chaos factor. The paper silver market. The COMEX silver market trades multiples of annual mine supply in paper contracts every year. That works fine in a sleepy market. But in a surging one, if enough longs demand delivery or enough shorts get squeezed, you can get a price dislocation that makes the Hunt Brothers saga look like a picnic. A friend of mine jokes that silver is like a coiled spring in a shoebox. For years, the lid's been held down by paper leverage, sentiment, and apathy. But once that lid pops, the energy release is disproportionate to the force that was holding it down. And I think we're on the verge of that pop. So where does this all leave us? If you're watching this and thinking, I'll just wait until the dust settles, you may be waiting at the station while the train leaves at full speed. I'm not saying chase vertical moves blindly. I am saying have a plan for accumulation and stick to it, because the next 5 months could rewrite the price history of silver. And when that happens, when the $50 level is shattered, when the financial media has its coffee spill moment, when your skeptical brother-in-law calls you asking how to buy silver, you'll know you were early and you'll know why that matters. In markets, there are few feelings better than being early, being right, and being ready. And in silver right now, we have the rare alignment of technicals, fundamentals, and sentiment to make that possible. So buckle up, the acceleration phase isn't coming, it's here. And if history is any guide, the real fun is just getting started.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.